and we'll go live in 3, 2, 1. Hey guys, welcome to episode 2 of Always Expect Disappointment and You'll Never Be Disappointed.
We're back with some more bad news.
Yeah. Last time we were talking about like how we should probably be a little bit more positive on what we're talking about, but yeah, we got more bad news. So the cool thing is though that William and I had no idea what was going on the last couple weeks. We've just been busy. I've been working on my business. He's been doing whatever he does. I still don't know what he does. And, you know, we're just kind of chilling. And then we were like, you know what? We need to record another podcast. So we were like, all right, let's get together. And then we realized market's not doing so great. And there's a whole lot of other things going on. And so we thought we would talk about it. Maybe let you guys know like what we think about it. But we kind of don't know what's going on either. So we've got plenty of windows opened up here on our tabs on Google Chrome here, and we're just going to kind of figure it out. So, but William, we'll start off with how are you doing today?
I'm doing good. I have been following it a little bit, not super closely, but just checking in every once in a while. I'm one of those people that I don't love to look at like my account balances all the time, because then I feel like I just think about it all the time, and I'm really worrying about it when really it doesn't matter too much to me, the day-to-day fluctuation. But I have been keeping tabs a little bit, seeing a few articles out there. So definitely a very interesting time, and sorry, it's probably going to be more bad news that we're going to be talking about today. So we're going to keep with that pattern.
Yeah, last time we talked about housing and how it doesn't look like it's really going to slow down much. Yeah, we think it might, you know, we think eventually will, but it doesn't look like it's going to right now. But yeah, we got some more bad news, so brace yourselves. But we're kind of in good spirits though, because our investment strategies and portfolios and all that good stuff is very, very, very long term. And so these kind of like, our portfolions expect at least, you know, 3 or 4 recessions in between the time that we're going to be, you know, taking out of it. But... So, yeah, so we kind of already predicted this, but we thought we would go ahead and kind of give an update on what's going on today. And it is March. No, not March. It's May. It's May. Has it been that long since we recorded? No, I'm just kidding.
It's been a while for sure.
14th since we or it's May 14th that we are doing this recording right now. Yesterday was my wife's birthday. Happy birthday, babe. I love you. Anyway,
she's not.
So let's jump right in. She's not. No,
I'm just kidding.
she's not part of our 7 fans.
She's not. Yeah, I mean, pretty much I don't want to say the world's on fire, but it's, you know, at least money's on fire right now.
Yes.
And I was talking with somebody the other day, and the thing is, like, when you're looking at retirement accounts specifically, like if you just have an investment account, then it may mean a little bit more. But if you're talking about just retirement accounts, you really only care how much it's worth when you need the money. Like, that's all that matters at the end of the day, is when you actually need to take the money out, that's when you care how much it's worth. So for somebody like Cody or I, where we've got a bit to go, these short-term fluctuations really don't affect us as much. At least they should. So if you have a while on your horizon before you're going to need to use these funds, don't panic just because things are going down. This is a good opportunity for you. Now it's cheaper to buy stuff than maybe it was a few months ago. So don't panic. That's basically the good news, is stay in the market. It's really only a loss if you sell, if you think about it that way. And so if you have the ability to ride it out and just stay calm, that's what you should do. As far as markets, let's get into that. So the great S&P 500, which Cody and I like to use, as far as measuring how the stock market is doing, in the past 5 days, and this is at least what the chart I'm looking at says, we're down about 2.4%. In the past month, we're down about 8%. 3 months is about the same, about 8% or so. That's inching actually a little more towards 9%. But then year to date, that's been the biggest number, is we're about 15, 16% down. And so there's been some pretty rough week. Like this last week, we're recording on Saturday, so this week before was pretty rough. That's where a lot of these losses are coming from. But I think the week finished Friday on a pretty decent note, at least coming up a little bit. I think it finished like 1 or 2% up just for Friday. but some heavy losses. So I know a lot of people are really worried about that. And then for those that were in crypto, definitely taking some big hits there. I know a lot of those people that were all in on crypto and they made a bunch of money, saw a lot of that money go out the door. So rough to kind of be in that space as well if you're invested in that, or at least have some of that. And then bonds are not doing great either. So most things, if it's not, I mean, housing's slowing a little bit, but it's still going up quite a bit. And then used cars somehow are still a decent investment. They're slowing down a little bit, but they keep still going up. So that's kind of a little bit as far as markets go where we're at. So most things are not doing well. It's just kind of the unique environment we find ourselves in. Sometimes the traditional logic was, oh, okay, when stocks go down, bonds should go up, or vice versa. But it's kind of the unique place that we're in with a high inflation environment. And then with rates increasing to combat that, you kind of got all of these factors coming in and kind of suppressing everything at once.
Yeah.
So definitely a time where you're hearing buy the dip come out a lot. A lot of posts about that. Cody, I don't know if you've seen those, but it's definitely still seems to be kind of the mainstream mentality is when something like this happens, it's an opportunity to buy instead of a time to kind of freak out. But I know it seems like a lot of people are still freaking out.
There's still a lot of freak out.
Yeah.
And I mean, with good reason. I mean, you've got inflation now is at 8.54%, which is a 40-year high, I believe.
Yeah.
The typical housing mortgage, or I'm sorry, the housing market is still going up, and your mortgage rates are now at 5.16% for a 30-year. And if you go on Zillow and you type it in, most people are going to see about 6% on its estimated. So that's a lot. That is double what rates were. Inflation is still way above the 2% that the feds want, or the 3% that is typical. And so there's going to be a lot more increases than that 5% that we're seeing of rates. And so you're going to see that increase. And the S&P was 17% year to date yesterday. And then now it's 15 because Friday didn't do too bad. It went up, like
kind of
about
corrected
2%.
out a little bit. Yeah.
So.
And to remind everybody what we talked about in the last podcast, with raising rates, the idea there is that's kind of easing up on the gas in the stock market, or in markets in general. And so that should help keep inflation under control rather than prices just keep going up and up and up. It should help kind of suppress things, but you're going to see these losses in the market as people say, okay, well, I'm not going to be earning as much, or it's going to be tougher to get capital for some of these businesses. It's going to be more expensive. It's going to cause some of these prices to go down. So it's kind of like a hand-in-hand thing of, you got to fight inflation by raising the rates, but you're going to also see these prices correct, because that kind of goes along with it, is, when keeping the, inflation rate kind of down. Then the other thing is, with housing, that's one thing we talked about last time, is you should see that start to slow, because, as Cody mentioned, when you kind of plug in that mortgage calculator, you're looking up how much it's going to be per month. When that rate goes up, it's going to really start to affect your monthly payment. And so it's going to be harder for a lot of people to be able to afford some of these houses. So it could be, down the road, you're going to see these housing prices start to decrease a little bit, just to kind of offset that, as people might be priced out of, some of the houses they used to be able to afford, but now the monthly payment's so high they can't really, afford to swing that. So that's why you're seeing that kind of pressure. And then with bonds, anytime there's a rising rate environment, bonds don't do well. So that's kind of the mix that we find ourselves in, right now.
So far, the only good investments are Honda Civics and houses.
Absolutely. Buy them Civies. So
so go stock up on your Hondas. Make sure it's used, and you'll have good investments. It's pretty interesting right now, because I don't know anything about crypto, but I'm hearing that crypto is really bad. Like, probably out of everything we just talked about, the worst
As far as percentages go, yeah, I would say
it's been for that. And the reason is apparently there's this Luna coin or Luna, whatever it's called. Let me see here. Terra Luna. Anyway, it's a stable coin.
Yeah.
So a stable coin, I believe, is supposed to be what it means. It's supposed to be stable. It's supposed to at least will be similar to the dollar. It's not supposed to fluctuate a lot. So 60% is what I'm hearing in a drop. And so a lot of people, and then what's interesting is usually when one gets, there's kind of like a cascading effect when it comes to coins is what or cryptocurrency is what I'm learning, is because one could be technically built off another one, or it could be linked to one. And so it's got like this cascading effect. Another thing that a guy I talked to last week, he's pretty big into cryptocurrency and such, and he was talking about how he's trying to kind of get out of it a little bit or slow down, not really get out per se, but slow down, because he started seeing mirroring of your typical coins and the stock market, which isn't what it's not supposed to do. He said that these coins with like Bitcoin, Ethereum, and all these higher up ones, they were supposed to be what you go to when everything else was going to crap, right? This is supposed to be like the alternative, but now it seems to be somehow following the same trends as that of the stock market. And obviously it's way more drastic, and I mean, I think Bitcoin's down 50% in the last couple of years. I think it was like 29,000 just yesterday when I looked. Yeah. And so, but he said that when one goes up, the other one seems to go up. When one goes down, the other one seems to go down. And he didn't like that. He said that he wanted it to be something that was more diversified. And so crypto is ending up not becoming what people thought that it was or was supposed to be.
Yeah. I haven't really looked into that too much. I guess my first thought would be maybe just because right now, and this has been a lot of people's complaint with crypto, is it's really worth whatever somebody will pay for it. Mm-hmm. And I know that seems like a lot of things, right? It's only worth what somebody will pay for it. But instead of being tied to something underlying, and I know there's some sort of value underlying it, but it's not as inherent as like you own a piece of a company with stock, or with a bond, you own that cash flow or the return. So I think it's more tied to like investor sentiment than a lot of people would hope. So I think that, and this is just my first thought, that may be why you see the overlap between stocks and crypto, is maybe when people are like all in and stocks are doing well, they're willing to throw some money into crypto. Whereas when things are going down, they're going to treat it the same. It's really just based off of how people are feeling about it and what people are willing to pay. And then there's some other factors, as you mentioned, like, if certain coins, like obviously if you say your coin's going to be pegged to $1 and then suddenly it's worth like 40 cents, like that's going to throw some people off. Like that's a big swing. So that's going to really like affect a lot of other stuff as well. But I think it's how people are feeling and what they're willing to pay is going to affect it the most. So that's why you see a little bit of that overlap instead of it being completely separate. Unfortunately, that's just kind of how it's been.
Yeah. And another thing I've noticed with, we were talking about this before we recorded, is Coinbase, which is probably the most popular platform for trading, I guess a marketplace for cryptocurrency. I guess that's what it would be called. Kind of like a Robinhood for cryptocurrency. It has been in a very just constant decline ever since it went public. And right now it is, as of 2021, it has seen a decrease of 80% in its stock price from $260 starting, or I'm sorry, $330 starting all the way down to $67. And it doesn't look like it's going to let up any. So there are some people that are kind of curious about what's going to happen to that. And so if that market itself, the cryptocurrency market, like if this one platform kind of goes away, the one platform that most people are using goes away, I'm curious, how is that going to affect, cryptocurrency as a whole as well? It's
kind of like, sorry, I didn't mean to interrupt, but I was just had a thought of, it kind of compares back to what people have discussed in the past with when there's like a run on a bank. If you're worried a bank's going to go under, everyone runs in and tries to cash out, right? Because they were afraid if that bank goes under, am I going to be able to get my money back? So I think there might be some similar concern with this, with this service of Coinbase of if it's not insured, which I need to look into see, if some stuff is like FDIC insured. But if it's not, then let's say that system goes under, they go into bankruptcy, whatever. What happens to your money that's invested with them? Are you going to be able to get it back? So I think the concern of selling or at least moving it was if they go under, am I going to lose whatever I have with them? So it's kind of a run on the bank, if you will. I think that was some concern. Was if they go under, am I going to lose my money? So I'm just going to pull my money out now and invest it, and use a different service or get out of the market entirely. But then you have a bunch of people doing that at the same time. It really helps even accentuate the downturn. So were you looking up if it's insured? Is that what
I was trying to figure that out. According to thefinancialgeek.com, it says Coinbase is FDIC insured.
Okay.
But that's not SIPC insured.
Gotcha.
That's the FDIC, which is like a bank.
Yeah.
So I'm curious
Or federal.
if it's just money that is sitting in a wallet and not necessarily like actual dollars that's sitting in the accounts ready to be invested. I wonder if that's what that is, or if that's what's insured.
Right. Yeah, we'd have to look into see what exactly. Yeah. And then I'm sure there's a limit. I think in most brokerage, it's 250,000. So not a concern for somebody like Cody and I.
Yes.
But
is my crypto FDIC insured on Coinbase? No. Your crypto is not FDIC insured on Coinbase. Cryptocurrency is not a legal tender and is not backed by the government, falling outside the scope of the FDIC. There are some crime insurances and cybersecurity breach insurances that Coinbase can provide. But no, it does not sound like any of that is going to be insured.
Okay. So unless you own
a coin.
So unless you have your coins, what's it called when you take them off? When you like just put it somewhere else, like not in a wallet, but in a, like you just stick it in a USB or something. Take it off. What's that called?
I guess that works.
Do you know what I mean?
Like a physical wallet? Is that a physical wallet?
I forget. Yeah. I'm not as versed in this, but
localized.
There you go.
I don't remember.
So if you don't have that, if you have it on a specific service or something, I think that was the concern. Is if that service goes down, what happens to you?
Right.
So that was kind of an added factor. And then Cody, I saw a lot of articles that are like, is this a recession? Is this going to be?
Oh yeah.
Or is this just a correction? What's this going to be as far as stocks? And I'd say you really don't know if you're in a recession until you're already through it. That's kind of the thing about it is you can kind of guess, and obviously this would look like the conditions of a recession, but it's also how bad is it and how long does it last? Because if it's just a quick downturn and then it comes right back up, you wouldn't consider that a recession.
Mm-hmm.
So I believe, unless it's changed, I believe the definition used to be 3 consecutive quarters of negative GDP growth, which is gross domestic product, which is just like, as far as a country goes, if you consider like a basket of like goods and services, whatever your country has to offer, is that price, increasing or decreasing? And so I think we've really only had so far, I think the first quarter of this year was negative, and then I'm assuming the second quarter is going to be negative, but things could turn around, by the third quarter.
Right.
And we're really not going to know that until the end of the year. And then there's not much you can do at that point. So it's one of those things, you can only see it in the rear view mirror. So we'll see as we come out of this if it was. But I think it's one of those things where you can't just call it while you're in the middle of it. Because then, third quarter, this could all turn around, back to work.
Right. I'm trying to find if that definition still, but I remember, 3 quarters of consecutive quarters of negative GDP growth. So
yeah, it's just like whatever your country produces, is it, growing or not?
Right.
As far as that. And I used the wrong definition.
Right. Which is interesting. Because I'm looking at the gross domestic product right now for the last, since 2018. It's been mostly positive every quarter, except for 2 quarters in 2020, the first and second.
That was crazy. Yeah.
That was crazy. First quarter went down 5%, second went to negative 25%.
Yeah, that was a big jump.
But then in the quarter 3, it jumped 35% and then went 5% in quarter 4. So 2020 as a whole went up 10%.
Yeah, so it netted out. So you could have been in second quarter 2020, and there was a lot of people calling that a recession.
Mm-hmm.
But if you go by the 3 quarters definition, we technically didn't hit that. Since in the third quarter, it bounced back more than enough to recoup.
Those 2 quarters are the only time that we had negative, and then the first quarter of 2022, has been negative by 1.4%.
And we're not even through the second quarter yet, so
exactly,
it could come back by that time. We don't know. My guess would be we'll continue to see some sort of a downward trend, but you never know how much.
Yeah.
So I think it's too early. That's I guess what I'm saying. Too early to call if it's going to be a quote recession. I think it's definitely you're in a correction territory. I think that's where you are in like the 10 to 15% down. But as those numbers grow, you're going to see a lot of people talk about, okay, is this just a bear market or is it going to be a recession? And I think you don't know the difference between those until after the fact, because you're going to say, oh, okay, looking back at the last 3 quarters, then we were. But I think you can definitely see a bear market just like, okay, we're down by 20% or more. That's that's where we're going to be in that territory.
Yeah. There's a lot of articles online about bear market. In fact, if you go on Yahoo Finance Market Watch or anything like that, you're going to see a bunch of pictures of bears.
Yeah.
Because that's just
all
hilarious.
the article headers. Yeah.
Right now, Market Watch has just 2 polar bears just playing and saying it's going to be a bear market. That seems likely to me.
Yeah.
So, but like recession's way too early. Like what you said, it's too early to tell. You're not going to know. You're not going to know until it happens, or you're already in it. But a bear market does seem likely. Usually that, and you can correct me if I'm wrong. Usually that means 20% loss in the stock market or like the S&P 500.
Yeah, I think from either an index or something like that, that would be considered. I think it's about 20%. So if you see losses of that or higher, that's when you'd get into that bear market territory. At least when we're considering that. I don't think that has as much of a time constraint on it. I think it's just based off losses. Whereas a recession, I think the definition is based off of okay, it's got to decrease, but it's got to last for a while. It can't just go down 1 month and then come right back up, or 1 quarter and then come back. It's got to be prolonged for at least 3 quarters.
Right.
So that's, I think, one of the key differences. So those terms, unfortunately, aren't as interchangeable as most people use them.
Right.
To be. So I guess here's a question I'll throw out to you, Cody. Is we hear a lot of people talk about buy the dip. And then you and I, we've said in the past, we're big proponents of dollar cost averaging, which is just putting in a set amount every month. So I guess what is your thoughts on balancing those 2 approaches? Do you think if you have extra cash, you should be trying to buy more? Or are you one of those people that's okay, I know I'm going to do the set amount every month, and then I'm just going to keep doing that regardless of what the price is doing?
Yeah, both.
Okay, yeah, that's fair. Yeah.
Dollar cost averaging, absolutely 100%. You need to keep that going forever. That should be the number 1 goal for your 401k, your IRA, and frequent is great. If you do a 401k and it comes out of your paycheck every week, that's awesome. I don't have that. I have an IRA, so it just comes out once a month, but I still think that's enough. 12 times a year is pretty good. But yeah, buying the dip is a good thing because it's on sale. Why wouldn't you buy something that's on sale that you think will probably go up? The thing is, what to buy? While I'm looking on articles on my mini tabs that's open today.
Yeah.
They were showing me all the stocks that we should buy because of this recent, quote unquote bear market that we may be seeing. And they were talking about some tech stocks. And so one of them was Nvidia. And, there's a lot of logic to it. I was looking at it myself. I don't know if you know about, cryptocurrency, but it's actually can be mined through graphics cards. Nvidia is a big graphics card. Seller, buyer, provider.
Producer.
Producer. There you go.
Yeah.
And so, the logic made sense. But what happens if and they were saying it's cheap right now. It is way low because of what's going on. You should buy it. That makes sense. But what if it doesn't? Right? So when I say buy the dip, I say buy the dip in your well-diversified portfolio that you've already been using for your retirement. I would not go say like, if you want to throw a couple bucks at it, that's fine. But that's like maybe some fun money. But if you're sitting on some cash, you want to buy the dip. The dip needs to be probably in the index, in an index or a well-diversified portfolio. I would not go buy.
Okay. You're not
these
scooping up individual.
Stocks.
Okay,
exactly. Not on. I think it's Market Watch that was saying that. Let me pull it up here. No, Wall Street Journal. Wall Street Journal had some recommended tech companies that you should invest in right now because they were on sale.
Interesting.
I've done it. I've bought individual stocks before. I've got a little bit of cryptocurrency. But if you look at a percentage of what my overall investments are, it's like in the 3%, right? Or 5%. The other 95% is sitting in an IRA, a Roth IRA that's well diversified and has a financial advisor looking at it, right? So if I had extra money right now and we were buying in the dip, I needed to buy some dip or I wanted to, I would probably throw my money at that and just tell them, hey, throw a little bit extra this month. But keep that dollar cost averaging. To be honest with you, with the way the economy is right now, the way inflation is right now, I really don't have a lot of cash available to be buying dip. But and I'm sure a lot of people, they're going to probably be struggling just to make the dollar cost averaging plan work for them. Yeah. And so I would say keep it going. If you have the money, that's great. But at the end of the day, focus on dollar cost averaging and, you'll be fine. You'll get through it. But try to, offset all this crazy inflation. Maybe go, I was reading an article about like ways to, get the grocery bill cheaper so you can still make your mortgage payment or your rent and still be able to invest as normal. And that's ultimately what's going to, get you to your end goal, but if you can buy some dip, that's great. And you should, if you can. Yeah.
Sorry. I just, every time I hear buy the dip, did you see that? I think it was like an E-Trade commercial that was like showed an auction and it was some people buying like different kinds of dip. Like
that's great.
like chips and dip. And so it was like, if this is what you think about when someone says buy the dip, you may need an advisor or something. That was like their commercial. I forget who was saying it, but that's what I think of every time. An interesting thought that I saw somewhere was all the time people talk about don't time the market. Like you can't time the market. It's not, so don't try because you're going to mess it up. You never know what it's going to be. But then we also say buy the dip, which is trying to time the market on when to buy.
Right.
So it is an interesting thought. So I think I would agree with your point of if you can do both, you should. I would just lean towards just dollar cost averaging, which is whatever your plan is. Like I think mine is like the 22nd or something of every month. And then with my 401k, it's like, every time I get paid, it just takes a percentage out. So I would just keep doing those. But maybe if you had some extra cash that you wanted to invest anyway, now would be a time to look at buying. But if I had, but I wouldn't let's say withhold anything that I was going to normally invest and say, well, I'm going to wait and see if it keeps dipping. I would just buy a little bit. The other concern would be don't take money that you need and just throw it in the market because you think it's going to come back right away. Mm-hmm. I know some people that think that way. It's like, oh, it fell 15%. So I'm just going to I need this money, but if I can just invest it in a year, it'll be back. Well, what happens if a year it's not back and you need that money? Mm-hmm. So I'd say if it's money you don't need right now that you can afford to leave invested until it comes back, then you can throw a little bit extra. But also think about too of if you get into this mentality of buying the dip, when are you going to know it's at the bottom? You're not really going to know that perfect timing. So you may buy and then, in a few weeks, it's gone down even more. And then are you going to be worried about that? So I'd say be disciplined, invest. Basically what I'm doing right now is I had a little bit extra that I had set aside and I just hadn't quite invested it yet. So what I'm doing is I'm just at a certain interval, I'm just buying a little bit at a time, still going through it. I'd say most of the time, if you've got a lump sum, it usually ends up at the end of the day just to go ahead and invest it. But as far as, if you just have the monthly amounts that you're doing, I'd say just keep doing that. I don't think there's really any rush. If you want to try to maybe work some extra jobs or do some different things to earn some extra money and then throw that in the market, you could definitely do it with the extra. But I wouldn't take from any of the other stuff you're doing to try to just like time the market perfectly. But I think if now would be a good time if you want to, if we keep seeing it kind of decrease, you want to throw some extra money in there. I don't think it would hurt. Just be prepared that you may need to ride it out for a little bit longer than you may think in order for it to come back up. It may not come up as fast as we saw in like 2020 when it was, 2 months later, we're back, better than we were before. It may be a little bit longer until you see that return again, but I still think we're at a discount, so as things continue to decrease, I'm buying along the way rather than trying to pick the exact bottom and then dump a bunch of money in then.
Right.
So I'm more of that kind of approach, and I think that's the way to go.
Gotcha. Yeah.
At least that's what I'm doing. So
yeah,
but you do whatever you want.
The timing the market, I mean, you can't do that. And you can. It's called dollar cost averaging. If you keep doing it, you are buying at the best time. Sometimes you may be buying at the worst time, but if you dollar cost average, you are buying some dip. It's just you're just doing it in intervals, and you don't have to worry about it. And so that's the cool thing about what Will and I do. We don't have to worry about it because we have a 30, 40 year plan. And so while all this is going on, we're like the meme with the dog in the house that's on fire, and we're just like, this is okay,
Yeah, I'm fine. I'm doing good. Because we're so far out. And it was funny, I was joking with somebody about like, you look at your investment account balance, and I had to double check my 401k because I was like, did they stop adding money from my paycheck? Because from the beginning of this year until now, it like hadn't moved like the total value in the account. That's great. So it was just cracking me up. I was like, they are taking it out of my paycheck, right? And I looked, and it was just funny because whatever I was adding each month, I was losing that amount. And so it pretty much had just stayed level like the entire most of this year. But really for me, that just means I'm buying at cheaper prices. So I get more of the stock than I did before. But it was just funny of just like, I know a lot of people are like, don't look at your accounts right now because it's pretty much going to be the same balance or lower than when you last looked at it. Yeah. So it's not going to look great. And I know a lot of people getting some bigger losses there. So, but if you don't need the money yet, you don't have to worry about it yet. At least that's my mentality. So it's
one thing to keep in mind, and we're going to have to go soon because about time. But one thing do keep in mind is if you are nearing retirement age or a time when you do need to get that money out, it is smart to look at safer investments.
For sure.
And don't be as risky, because I'm sure there are a lot of people right now who thought about retirement and they looked at their 401k and it isn't pretty right now. And they're probably like, you know what? I may have to ride this out. I may have to wait a few years before then I go into retirement. So it is smart to, look at that, see where you are, where your goals are. If it's only 10 years out, then you might be fine, but it isn't only 5 years out. It may take a little while for this to come back to a point where that nest egg looked like what you wanted it to look like. And so that's just something to kind of keep in mind is maybe as you are getting closer to that point of when you do need the money, then you do need to start paying a little bit more attention to the market and maybe start making some adjustments. But when you're our age, 25, and we ain't going to retire for a while, then just keep going. It'll be fine. It'll work out in the end.
Exactly. So you may want to shift. If you're getting closer, you can shift to either something more conservative or just start taking a percentage and, start maybe say a certain percentage of your portfolio you want to have available. And then even if the rest decreases, at least you've got a set amount that you're like, okay, I can definitely live off this. So you're not like, oh, suddenly I can't afford to, live as long or, retire as long as I thought. And so, or maybe keep up a certain lifestyle that you were hoping for. So I'd say definitely look at, if you're getting closer, see if there's something safer, or at least keeping some cash reserves so you can make it through any downturn. But if you're our age, I'd say you don't need to be checking it too much. You can just leave it. Let's set up the plan and let it go. Go live your life. Don't be sitting there looking at a screen panicking. So yeah, go out and do fun stuff rather than worrying about your account balances right now.
Right.
So,
all right, guys.
that's good stuff.
We hope you appreciated that update of what's kind of going on, our take on what's going on, and if you get any questions or want to know anything else about all the stuff that we said, we're not professionals, but we do, we like to read this stuff. We've studied this stuff through college, and so we do enjoy it. So if you get any questions, just let us know. Hit us up on social media, and then give us a 5-star review on Spotify, Apple Podcasts, wherever you're hearing this. We would really appreciate it. But anyway, we will see you next time.
See you guys.